Welcome to this explainer. Okay, I want you to imagine, just for a second, that a friend comes up to you and asks for a massive loan. But here's the catch. They tell you they won't fully pay you back for a whole decade, and along the way, they're only going to toss you a tiny fraction of their profits. You would absolutely laugh them right out of the room, wouldn't you? Well, when the government does exactly that, that is what we call the absolute thrill ride of modern investing. Today, we're looking at the wild reality of willingly handing your cash over to the state. Let's dive right in.
I mean, really picture this scenario. Think about taking $20,000 of your hard-earned cash, money you could easily use for a house down payment, a new car, or maybe investing in a fast-growing startup. And instead of doing any of that, you give it to the government. Then you just sit there and wait a grueling 10 years to get it back, getting handed a little paper coupon on the side as a thank you. Sounds like the deal of a lifetime, right? But all sarcasm aside, believe it or not, this exact bizarre leap of faith is literally the bedrock of our entire global financial system.
So let's break this down. You just bought a government bond. What did you actually buy? Honestly, it's essentially a glorified IOU from the state. You see, governments need immense amounts of capital to fund public spending. Think everything from massive highways to healthcare systems. To get that cash, they issue these sovereign bonds. You give them your money, and they give you a promise. They promise to pay you periodic interest, which we call a coupon payment. And fun fact, they're called coupons because back in the day, bonds were actual physical pieces of paper with little tear-off tabs that you'd literally take to the bank to collect your cash. They also promise to pay back your original loan amount, the face value, on a specific maturity date down the road.
Right, so they pay you an annual interest rate. The ratio of that payment to the current market price of the bond is what we call your current yield. But here is where we hit a really deeply fascinating, kind of ironic twist in government finance. Your current yield actually tends to shrink if the government gets better at budgeting. Let's walk through the math on this. It's pretty wild. When a government's budget balance improves, suddenly their debt looks incredibly safe. Because it's safer, everyone wants to buy it, which drives the market price of the bond way up. But remember, your payout, that coupon, is totally fixed. So if you're paying a higher price up front for the exact same fixed payout, your overall percentage return, your yield, actually drops. Good government behavior literally lowers your yield.
So you might be wondering, why on earth did governments invent this system in the first place? Let's check out the timeline. Spoiler alert, it definitely wasn't to help you grow your personal wealth. Most of the time, they just desperately needed cash to fight wars. Look all the way back to 1172. The Republic of Venice didn't even politely ask for money. They issued forced loans to fund their defense. Fast forward a bit to 1694, and William III of England used a syndicate of investors to buy debt for the 9 Years' War. That specific syndicate was granted a royal charter and literally became the Bank of England. Jumping ahead to 1775, the American Revolution simply couldn't have happened without citizens crowdsourcing $27 million in bonds. Basically, governments lean on bonds when their very survival is on the line.
Now, if you fast forward to today, governments absolutely love to tell you that bonds issued in their own currency are strictly risk-free assets. But, as we're going to see in this explainer, that is a massive illusion. That shiny risk-free label is actually hiding 4 major, very real risks that can completely derail your investment.
First up is credit risk. This is the absolute nightmare scenario, a sovereign default, which is just a fancy way of saying the government chooses not to pay you back. A lot of people think countries won't default on debt in their own currency because, hey, they control the money printer, right? But it actually happened. During the Russian ruble crisis in 1998, Russia actively chose to default on its domestic currency debt. Why would they do that? Because the alternative was printing so much money to pay off investors that it would have triggered runaway hyperinflation. They literally chose the pain of a default over completely destroying their own currency.
And this brings us to what a severe sovereign debt crisis actually looks like in real time. Look at the staggering disparity here between Greek and German bonds during the Greek government debt crisis. International credit rating agencies downgraded Greek bonds, and investors absolutely lost their minds. The spread between the two peaked at astronomical levels. Investors demanded a 26,000 basis point premium, and keeping in mind that 100 basis points is just 1%, that is a 260% premium. They demanded that just to hold 10-year Greek debt, compared to a peak of just 40% for German bonds. Investors basically looked at Greece and said, "No way, you have to pay us a gigantic premium to take on that terrifying credit risk."
Okay, number 2 is currency risk, sometimes called foreign exchange risk. This one really stings if you decide to buy a foreign bond. Imagine you're a German investor and you buy a United States bond. You do everything perfectly. You do your research, you invest, and the US government pays you exactly what it owes, right on the dot. But if the US dollar suddenly tanks relative to the euro, that exchange rate fluctuation completely wrecks the value of your asset. A bond paying out in a currency that is losing value against your home currency is just a terrible deal, no matter how amazing the interest rate looked on paper.
Third is inflation risk. This is the one that quietly, stealthily just eats your purchasing power over time. It's the danger that your real rate of return, which is your return after you adjust for inflation, is actually going to be negative. Think back to that $20,000 you locked away earlier. If your bond pays a 5% fixed interest rate, but overall inflation is running at 4.5%, your real rate of return is a measly 0.5%. The prices of everything around you are rising almost exactly as fast as your interest is piling up. So you aren't really growing your wealth at all. You're literally just treading water.
Fourth, we have interest rate risk. This operates on a strict, totally unbreakable inverse rule. If new interest rates go up, existing bond prices must go down. It's like a seesaw. Let's say you buy a 10-year bond paying a 3% coupon. But a year later, central banks raise overall interest rates to 4%. All the newly issued bonds are going to pay that higher 4% rate. Suddenly, your old 3% bond looks pretty pathetic to everyone else. If you want your money back early and try to sell that bond, its price falls. You're going to be forced to sell it at a major discount because, frankly, nobody wants a 3% return when they can just go get 4% everywhere else.
All right, so now that we've dug into the mechanics and those 4 sneaky risks, let's shift gears a bit. Where are people actually trading these complex IOUs today, and what does the market look like? Let's take a tour of the 2 absolute titans of the modern bond world, the United Kingdom and the United States.
Over in the UK, government bonds are known as gilts. They're handled by the UK Debt Management Office. And here's a cool piece of trivia for you. They're called gilts because the original paper certificates actually had gilt or gold painted on the edges. What makes modern UK gilts so fascinating is their incredibly long time horizons. They have maturities stretching much further into the future than most other European bonds. And because they stretch out so far, they've actually heavily influenced the development of the entire UK pension and life insurance markets. These massive institutions absolutely rely on these ultra-long-term predictable investments to guarantee they can make payouts decades down the line.
Let's look at a concrete example to put some actual numbers on this. A conventional gilt has a fixed interest rate and a specific lifespan. For context, if we look at July 2025, a UK 10-year gilt was yielding 4.45%. Now, this was backed by an AA credit rating from Standard & Poor's with a stable outlook. Just so you know, an AA rating is incredibly safe. We're talking high investment grade, just one tiny notch below perfect score. At that same time, the official Bank of England base rate was sitting at 4.25%, so investors were essentially getting a very slight, reasonably safe premium of 4.45% over the base rate just for locking their money away with the British government for a full decade.
Then you look across the Atlantic to the US Treasury market, and it is just an absolute behemoth. It is the largest, most liquid market for government securities in the entire world, doing an astonishing $900 billion a day in transactions. The US Treasury offers this whole menu of marketable securities, basically tailored to how patient you are. Want it over fast? Treasury bills mature in a year or less. They don't even bother with coupons, you just buy them at a discount. Willing to wait a few years? Treasury notes have you covered for 2 to 10 years. And if you're playing the long game, you can lock in a 20 to 30-year Treasury bond. They even throw in floating rate notes that adjust with current interest rates.
But arguably the coolest innovation on this slide is TIPS, which stands for Treasury Inflation Protected Securities. They are brilliantly engineered to solve that sneaky wealth-eating inflation risk we talked about a minute ago. How? By continuously adjusting your principal amount up and down in real time, matching the consumer price index. If inflation spikes, your underlying principal goes up. That means your interest payments get bigger too, since they're a percentage of that new, higher principal. If deflation happens, it goes down. And the best part? By the time the bond matures, you get either the adjusted principal or your original principal, whichever is higher. So both your ongoing payments and your final payout are completely shielded from inflation.
Which brings us to a seriously fascinating paradox to close out this explainer. Because remember, a domestic bond is technically considered risk-free for one main reason. A sovereign government can always, theoretically, just spin up the printing presses and create more money to pay you back. But as we saw with the Russian example, if a government creates immense amounts of new currency to service their debt, they ignite runaway inflation. So think about it.
If a government just prints money to avoid a technical default, is a quote-unquote risk-free bond actually the single riskiest bet you can make against your own purchasing power? It's a massive, built-in contradiction, and definitely something to carefully consider the next time the government politely asks to borrow your hard-earned cash.